Greens this week, rebounding from last week's lows, and the commodity is currently trading near the $79 per barrel. Supporting the ascent to higher ground has been growing concerns over supply shortages alongside rekindled optimism for recovery in demand. Furthermore, the shutdown of Turkey's Ceyhan port this week in the aftermath of a devastating earthquake incident on early Monday morning provided further support for crude prices alongside Saudi Arabia's announcement that it would lift crude prices for Asian markets in attempts to capitalize on demand from China and India. In this report, we aim to shed light on the catalyst driving WTI's price and assess its future outlook. Earlier this week, the head of commodities research of Goldman Sachs, Jeff Currie, reiterated the bank's projections for crude oil prices for the year ahead. Currie foresees WTI prices rising to $100 per barrel, making the commodity one of the best-performing assets in 2023, since without sufficient supply, capacity and investment, crude will run into a long period of shortages, which will then lead to higher prices. Albeit his call being considered as bold, Currie noted that crude and commodities by an extent are in a multi-year supercycle, and the current consolidation near the $75 per barrel range will serve as the floor where WTI is expected to rally from. His expectation pointed out that by May, oil market should flip to supply deficit as underinvestment, lack of exploration, and low stockpiling efforts from the Western nation, combined with China's insatiable hunger for oil following its full-fledged reopening, would create a bullish consumption for WTI prices. Sharing a similar outlook with Goldman Sachs is Morgan Stanley, who also foresees dwindling spare capacity production around the second half of the year, which propel prices north of $100 per barrel. Sitting on the opposite camp from Goldman Sachs is JPMorgan Chase head of commodities research Natasha Kaneva, who expects oil prices struggling to reach the $100 per barrel mark should there be an absence of geopolitical event. The rationale behind the projection is based on the expectation that many developed and developing economies will decelerate substantially throughout 2023. Therefore, deteriorating economic growth and activity would inadvertently diminish demand for oil, capping the commodity's ascent to higher levels. Countering Goldman Sachs' views for an impending supply shortage due to underinvestment and low levels of spare capacity, Kaneva stated the reality for the oil market is that there is simply more supply than demand this year. Siding with JPMorgan's bearish outlook is Citigroup head of commodities research, Ed Morse, who warns that global oil demand will see only meager growth this year and forecasts that crude would trend around $80 a barrel in 2023. Thank you for watching.